Hi folks, Joe DeSanto here. Thanks for joining me again in another video. In this video, I'm going to cover the topic of financing for small businesses, the ins and outs of financing, what options are available, and how they affect your credit or not, and other topics. So hopefully it's helpful. I'll see you in the video. Thanks. I'm Joe DeSanto, by the way. I'm an independent CFO and business consultant. I actually spent most of my career in Los Angeles building a few multi-million-dollar businesses, and I've since semi-retired, and now I help other businesses and individuals manage their money and plan better for their future. So if you're interested in small business, personal finance, and real estate advice, please subscribe to the channel. Thanks. Hey again, folks. Okay, so in this video, I wanted to talk a little bit about financing. As you can see up on the screen, I have a couple articles on my website about business loans to consider for your business, and also an article about getting business credit cards that won't affect your credit. So I just want to cover financing a little bit in general. And a lot of people ask me about this, especially when they're starting a business. You know, like, how do I go about getting a loan to start a business? And the truth of the matter is, it can be hard because it's a new business venture. So that's, oftentimes a risky endeavor, especially from the point of view of a bank. And also, you establish no income and repayment history for the business, and no income at all because it's new. So getting loans to start a business just generally can be difficult. And the question is, like, what kinds of loans can you get? What is commonly used as loans to create initial, working capital to start a business come from a few sources, and you're probably not going to love these sources. But so number one would be personal funds, and that obviously is what it is. You've saved money, you've thought about starting a business, just like you might save money for buying a house or whatever, and you put your own capital up and get going that way. Another thing people commonly do is go get money from friends and family. So in essence, you're either taking a capital contribution or an investment in the business from friends or family, meaning you're not promising to pay them back. You're promising them that your business is going to be successful and that, you're going to turn their money into more money at some point in the future. Or you take that money in form of a loan and you pay them back with interest, and maybe it's a fixed thing, a 5-year loan or a 10-year loan with an interest rate, and you create an amortization schedule and you pay them back that way. Another way people get initial funds for starting their own business is doing a home equity line of credit. If you own a house and you have equity in there and you can take out a loan against the equity of your house, that is often the way people access funds to start their own business. That is something that I did when I started my business. I used my home equity line of credit. Obviously, it's risky. I mean, starting a business and quitting a regular job and whatever is risky in and of itself, but then obviously putting up money, particularly home equity, can be a risky bet, but you're betting on yourself. So that's a way people often get larger amounts of money. If your startup costs are small, you oftentimes, the easiest loans to get out there in the world are credit cards. These days, credit cards have higher interest rates, so it's not ideal, but you can generally get reasonable, borrowing ability on personal credit cards, and you can start that way. Now, those are all startup funds, but inevitably, actually, I should say the fifth way, and this is an important one, is a loan from the Small Business Administration. So the SBA, as it's called, is a government organization that endeavor is to help people start businesses because businesses create jobs. So what they do is they team up with regular banks, but they say to the bank, listen, we're going to come in and essentially almost be a co-signer on this loan for this person. we've approved them for an SBA loan. The regular bank, could be Bank of America, Wells Fargo, credit unions, whatever. They give out SBA loans, and the SBA guarantees the loan, meaning if you go belly up and you don't pay the loan back, the SBA will come in and pay the loan back, either in full or in part. And you can get new business loans, working capital loans, lines of credit. You can get loans to buy real estate as investment, or real estate even if you're going to occupy it. So the SBA basically will come in and help you get a loan because they want you to start a business and they want you to be successful, right? However, the SBA's requirements oftentimes are more stringent, than the banks themselves, and it can be hard to get an SBA loan when you've not started the business just based on a business plan. So all of these ways of raising capital for your investment can be challenging. But that's kind of what you're looking at by and large in the beginning. Now, once you start a business, open an entity, there's a couple of factors at play. One, the bank wants to know, do you have an entity and it's been around for a certain period of time? They like the entities to at least be around for at least 2 years. Usually when you start your entity and you open a bank account, you'll be offered a credit card. And I want to talk about those a little bit down the road. But I usually suggest people get the credit card and at least get some kind of credit going for the business itself. Now, this is a big caveat about any kind of business credit. If you don't have a business, you're more likely going to be taking out a loan in your name, and it might be from your home equity line of credit or with a family or whatever. Once you have a business and it's been around for 2 years, and hopefully you probably established a little credit with a small credit card, you may become eligible for the business to get a loan. Okay. And the business obviously has to show income and profitability, hopefully, and you still probably need some version of a business plan and projections, financial projections for the coming years, but you'll be able to get a loan in the business name. Here's the thing, though. Everyone thinks that, oh my God, I can get a loan in the business name and I have no responsibility for it. That's not the case. Until you've built up probably at least 7 to 10 years of business lending and have payment history and so on, you're going to have to personally guarantee any business loan you get. So it's really no different than you at least from a credit point of view, going out and getting a loan like it's your responsibility. I guess the difference would be that most business loans don't report to your personal credit unless you're in default or something bad has happened. So, and that's an important thing, because if you're familiar with your credit score, the more loans you have that are unsecured, the lower your credit score will get. So you could go get a business loan from a bank or through the SBA, and that loan balance won't show up on your credit score. So that's important. Now, back to the initial credit cards. Business credit cards, especially in the beginning, they'll also give you credit in the name of the business, but you will be personally guaranteeing the business credit card also. Now, to the point of reporting to your personal credit, some of them do and some of them don't. So I have this article on my website called Get a Business Credit Card That Won't Affect Your Personal Credit. And in here I have a list of, at least at the time of writing this, which honestly was a couple of years ago, how the credit cards report to your personal credit report. For example, Amex will not report the balance you have on a credit card, but if you go into default, it will report that and basically show you not paying your bills. Capital One will report on some cards, but not on others. Citibank doesn't report the balance even if you are delinquent, so that's really good. Discover reports both the balance you have on the card and delinquencies, just as though it's a personal credit card. So each of the banks do it a little bit differently. So what I like to do is, suggest you get a card that at the very least doesn't report the balance of the card to your personal credit report. But if you can go with something like a Citibank that doesn't report the balance or the delinquencies, you actually get in a position where it's almost like business only credit. So that could save you in the wake of a disaster or something. But other loans that you get, whether it be SBA or just a bank working capital loan, which is them essentially giving you a lump of money to go do something with, or a bank line of credit, which is usually kind of like a credit card, like a revolving line of credit. They're usually not going to report the balance to your personal credit report, but they will report delinquency, because if you become delinquent on the loan, you personally guaranteed it, and now it becomes the responsibility of you personally, right? So that is something to consider with business lending. Does it report to your personal credit? Do you have to personally guarantee it? And so on. And again, before the business is open, you're going to be personally on your own. Once the business is open, but at least 2 years, but not up until probably 7 or 10 years, you can get funding on the business name, but you're going to have to personally guarantee it. After, at least 7 years, if you've done enough lending and paid off enough lines and you can prove good credit history, there are some types of loans you can get that don't have a personal guarantee and are solely the responsibility of the business. And that's obviously kind of the gold standard and what you hope to eventually achieve, but it does take some time. Now, I'm going to close the video in talking about some other kinds of business loans, that maybe are not so obvious. So we talked about a thing like working capital loan or line of credit. The working capital is you get a sum of money. Usually you're paying back in a fixed term at a fixed rate, kind of like a mortgage. The line of credit is an open revolving line of credit. Usually you have to renew it every year. And oftentimes it's intended for the use of bridging the financial gap of waiting for invoices to be paid or to front money for inventory, but it's not meant to be drawn and paid back over many years. Most lines of credit, they want you to actually get the credit line paid down in full at least one time throughout the year, so they know you're not using it as a long-term loan. Lines of credit and term loans can be collateralized by certain things. So if you have receivables, meaning you send invoices and you always have a certain amount of money that you have coming in, you can help get your line of credit by using the receivables as collateral. So there's a mechanism called a UCC filing that allows the bank to get essentially access to your receivables if you go into default. They can call your customers and say, hey, you have to send that money to me now. You can also use business assets if you have them as collateral, like maybe you have furniture, maybe you have equipment, maybe you have a car, vans, whatever. You can oftentimes use those as collateral for a working capital loan or a line of credit. Another type of loan that's one of the easiest to get once you're in business and established is an equipment loan. An equipment loan is like, hey, you're going to go out and buy cars, or you're going to go out and buy a printing press. You're going to go buy something that you're going to use to make money with, number one, but also is something that retains value. So an equipment loan says this, hey, we'll come in, we'll buy you the equipment. The equipment will essentially be our collateral for the loan. We as the bank will own the equipment, and we'll rent it to you for a period of time. And so in a sense, you're leasing the equipment from the bank that purchased it on your behalf. That's why it's sometimes called equipment leases as well. Now with these leases, they can be leased to own, meaning if you have a 3 to 5 year term, maybe 3, maybe 4, maybe 5 years, once you meet your leasing requirement, they say, hey, give us $1 and you can now own the equipment. But the whole time, they own the equipment. So if you default on the loan, they can easily come get the equipment. Not dissimilar from a mortgage where, when you go buy a house, you own the house, but the bank has a lien on the house saying if you don't pay, they can come sell it on your behalf. Well, equipment financing makes it easier for the bank. The bank literally is the owner until it's paid off. Some leases, though, you don't actually have to pay $1 and own it. If your equipment loses its entire value within 5 years, you might do like a thing where you don't actually ever own the equipment. You'll pay less or less interest rate or something. They own it and they can keep it and sell it at the end, and you go and lease a new piece of equipment from them. So equipment leases offer a few different options of terms and so on, but they're, in my experience, some of the easiest loans to get once you have an established business that's at least 2 years old and has some revenue. And you don't even need that much other credit history. So it's a good way to build credit history for your business. So working capital loans, revolving lines of credit, and equipment leases are some of the most common types of things. Working capital lines of credit, you can go to the SBA to, get help and assistance with getting approved. So that's something you would definitely want to consider. And again, if you're in business, something that we did as business owners, we ended up buying the building that we occupied, much like you buy the house you live in, right? Well, we bought the buildings we occupied and used, and we got SBA loans to go do that, and we got favorable rates and lower down payment and so on. So those are some of the kinds of business financing, that you can get into, and it just kind of changes over the course of how long you're in business and how long you've built credit history for. If you want to do some more reading about that, again, I have these 2 articles on my website, 5 types of small business loans to consider and how to get a credit card that won't affect your personal credit. And hit me up if you have any questions. I'll talk to you later. Thanks.